Welcome to ZICA Academy YouTube channel. In this lecture, I want to examine the audit approach. If you are coming across my lecture for the first time, please like the video and also share it with others. If you are a returning subscriber, I say thank you for being part of this channel. Audit strategy. Audit strategy. Audit strategy is the overall approach that the auditor decides to take for an audit, from which detailed audit plan can be developed. Overall approach that the auditor decides to take for an audit. An approach that the auditor decides to take for an audit for which or from which detailed audit plan can be drawn or developed. So audit strategies include, number one, we have the risk-based approach or business risk approach. Risk-based approach or business risk approach. Risk-based approach or business risk approach. The second one is system-based approach. System-based approach. System-based approach. The third one is substantive testing approach or substantive test approach. The fourth one is a statement of financial position. Statement of financial position approach. This approach shall be examined one after the other. The combination of two or more approaches may be used for an audit of an organization. An auditor may decide to use two or more of these approaches together for an audit of an organization. So, what do we mean by risk-based approach or business risk approach? Risk-based approach or business risk approach. Under this approach, auditor concentrates most of the audit work on area of high audit risk. Auditor concentrates most of the audit work on areas of high audit risk. In my previous lecture, I've examined audit risk. I've told you that audit risk is a combination of inherent risk, control risk, and detection risk. Audit risk is a combination of inherent risk, that is audit risk, equals to inherent risk times control risk times detection risk. The combination of this is what make up the audit risk. Inherent risk is the risk of misstatement that result from the inherent characteristics of the items. The risk of misstatements that results from the inherent characteristics of the items. That is inherent risk. I want you to know that the higher the inherent risk, the higher the risk that an item may be misstated in the financial statement. The higher the inherent risk, the higher the inherent risk, the higher the risk of an item being misstated in the financial statement. Number 2, we have control risk. Control risk. Control risk is the risk of misstatement that the internal control of the entity will fail to detect or prevent. The risk of misstatement. The risk of misstatement that the internal control of the entity will fail to detect or prevent. That is control risk. Number 3, we have detection risk. Detection risk. Detection risk is the risk of misstatement that the substantive testing will fail to detect. The risk of misstatement that the substantive test or substantive testing will fail to detect. That is detection risk. Remember, I've told you earlier that the risk-based approach can also be called business risk approach. The objective of business is to maximize profit or to maximize shareholders' wealth. So since the objective of the business is to maximize profit or to maximize the shareholders' wealth, business risk approach are therefore the threats to the ability of the business to achieve its objectives. The threats to the ability of the business to achieve its objectives. That is business risk. Business risk are the threats to the ability of the business to achieve its objectives. Some of the threats might include the loss of major customer or increase in cost of key commodities, loss of key employees. This could be a threat to the ability of the business from achieving its objectives. Business risk could impair the going concern assumptions of the financial statement. It could impair the going concern assumptions of the financial statement. In risk-based approach, auditors should develop an understanding of the events and circumstances that may affect the ability of the entity to achieve its objectives. Business risk approach can also be called top-down approach. Top-down approach with the business at the top and financial statement at the bottom. Business will generate the financial transactions that will be at the top, while the financial statement will be at the bottom. So, classification of business risk. Classification of business risk. You may be asked to identify some of these risks in a case scenario. Business risk can be categorized into two. Business risk can be classified into two. We have the external and internal. External business risk and internal business risk. I want to start with external business risk. External business risk or external factors that may prevent the entity from achieving its objectives. So, external business risk are business risk that arises from the external environment of the business. This factor arises from the external environment of the business. They include one, loss of the major contract, loss of major contract as a result of dispute with customers, loss of major contract as a result of disputes with customers, loss of major contract as a result of disputes with customers. This is one of the factors, it's an external factors that constitutes a risk to the business. So, number two, long-term decline in demand for companies' products. Long-term decline in demand for companies' products. Long-term decline in demand for companies' products. Number three, influx of competitors into the market. When there are entrants of competitors, when competitors are coming into the market, it's a risk to the business. Influx of competitors. Influx of competitors into the market. This is a risk to the business objective. Then changes in laws and regulations that affect the business. Changes in laws and regulations that affect the business. Sometimes some business may be banned from the market. Then another one, the effect of recently discovered technology. Effect of recently discovered technology. This may constitute a risk to the entity, especially where the entity does not have the finance required to acquire that technology, or even if that technology are in place, they do not have people who have the technological know-how, people who can manage it, people who can operate it effectively. If the entity did not have that, it will constitute a risk to the entity. Then the impact of natural hazard. The impact of natural hazards. So, for instance, if there are floods, that is a risk to the entity. Flood might destroy so many things in that entity. Threat from competitors to a company's patent or copyright. Threat to threats from competitors to the company's patents or copyright. So this could pose a significant risk to the entity. Changes in microeconomy, such as changes in interest rate or changes in exchange rate, all this might pose a significant risk to the entity. So we have so many factors that can serve as a threat to the business entity. Number two, we have internal business risk. Internal business risk are caused by the factors within the entity itself that pose a significant threat to the company's objective. Factors within the company itself that pose a threat to the company's objective. We refer to those factors as internal factors or internal business risk. This include loss of key employees, loss of key employees, loss of key employees, loss of key employees. The employees that have the technological know-how, who is more effective or efficient in that organization. Maybe the organization loses it. So it might even affect the going concern of that entity. Then ineffective employees. Ineffective employees. Where the employees are not effective, where they are not effective enough, that can pose a significant threat to the organization's objective. Then we have weak management. Weak management. Where the management are not efficient, where they are weak, that might affect the business ability to achieve its objective. Lack of customers cares. Lack of customers cares. It's not limited to those one I will give to you. So there are a lot of factors within the entity itself that pose a significant threat to them. Poor financial management. Poor financial management. Weak internal control system. Weak internal control system. Where the internal control of the entity, the internal control in place, where it is very weak, it can pose a significant risk to the entity. Lack of finance. Lack of finance. Lack of finance required. Especially where the entity did not have enough finance, or they did not have enough funds for their capital projects, that could pose a significant risk to the entity. Over reliance on one key individuals. Over reliance on one key individual. If the entity relies on one particular person, and that one person is not willing to support them in that service, so that means the entity might not be able to perform that service. So it will affect their objective, the ability of the entity to achieve its objective. Fraud or misappropriation of assets. Fraud or misappropriation of assets. It's not limited to this. It's more than this. I just gave you this as an example. In an examination question, you should be able to identify business risk in a case scenario, you should be able to identify them when you are given a case study question in your audit. Then you should be able to identify business risk. You should be able to identify both the internal and external business risk. Business risk is different from financial statement risk. You need to be able to differentiate between the business risk and financial statement risk. Financial statement risk. This will be examined in details in another video. A business risk, I have told you, is different from financial statement risk. Business risk is the risk that the business will not be able to achieve its objectives. The risk that the business will not be able to achieve its objectives, that is business risk. That is, they are the risk that impair the ability of the business from achieving their objectives. That is business risk. Financial statement risk is the risk that the financial statements will not give a true and fair view due to misstatement or omission. The risk that the financial statement will not give a true and fair view due to misstatement or omissions. That is financial statement risk. Or you can say financial statement risk is the risk that the financial statements were incorrect. The risk that the financial statements were incorrect. Maybe misapplication of accounting policies or failure to make adequate provisions in accordance with IAS 37 and so on. So the risk that the financial statements were incorrect. So we continue this business risk approach in another video. I will give a comprehensive work example in another video. Please make sure you drop the love emoji and also share the video with others. Thanks for watching ZICA.